In trading, you must have that ability to adapt yourself, which is the most valuable skill at trading. From the very beginning, I will repeat myself that trading is a difficult job, and it is not meant for everyone for sure. To be successful at trading, you must apply discipline, consistency, critical thinking, and much more. Only way to become a real and profitable trader is start from learning. Because look, in order to become a doctor, you're not going to make some surgeries first because you so believe into yourself. No, it would be collision course. And no place on earth would allow you to do so, because it might cause some serious health issues for somebody. So, to become doctor, you need to learn, practice, learn, and after a decent number of years, you can be doctor. So same in trading. You must learn, practice, and only then you will have a standing chance to become a trader. I hope you understand that. And if you want some cheap and easy money, then you are not in the right place, my friend. Maybe this is not what you would like to hear, but it is what it is. I can't say that it would be easy and soon you will be rich as hell, but it is not the case. Nowadays trading is way different than it was 15 or whatever years ago. Things are changing very fast, and the best that you can do is change together with the market. Do not try to change the market, otherwise it will break you, believe me. Speaking of facts, so only facts are useful. I do not care about opinion, and you should not either. Remember, that opinion is the lowest point of knowledge. Of course, there are many opinions in the world which makes a huge influence. But in businesses, you should pay attention to facts. Take everything seriously, because trading is not easy, and you need to know and learn many things. Trading is like combinations of many parts: risk and money management, psychology, technical and fundamental analysis, and few more. But these are main ones. The biggest part of all is psychology. In many opinions, is between 50 to 70% of your total trading success. Psychology is the main part because it really shows who you are and how you act in different situations. Trading is very emotional and so risky job, and you have to have that ability to control all. Also, big part of trading success depends on risk and money management. You have to stick to the rules and never ever break them. Otherwise, do not blame anyone for your losses. Great example is when an alpinist climbs to a mountain. He always watches where to put his leg and calculates all his steps and actions. And there is not a slightest thought to take a riskier one, because it could be his last one. So same in trading. Risk and money management rules are golden rules and should never be broken. Matter of fact, it is also part of psychology. In conclusion, trading is a complex job which requires to master quite a few things, including patience and consistency. You can become successful over a few months. Nowadays trading is way different than it was many years ago. But even then, the situation changed often, and one profitable strategy didn't make you successful. So you have to be flexible and adjust yourself over time to the market. Everyone would like to become rich for the next few months because he heard about trading from some guru on YouTube or TikTok who showed you fancy lifestyle which is easy to get for trading as he says. All you need is to buy some cheap $50 learning tool he provides and that is it. You are rich. Congratulations. Well, the sad truth is that it won't happen. I'm sorry. The truth about real traders who making money year by year is that they do not show their real self for most of the time. Why would they? They have everything what they need, more than amazing rewards from trading. To show numbers they're getting for some dummies are just sad. Just think for a while. Why most of the rich persons not showing their real lifestyle? So I think you are smart enough to understand if some person shows some incredible amounts of money he makes using some simple tool is a scam. All he wants is your money. It is so sad that they're using other people's inability to think for their own self-satisfaction. So you need to find real and good information, which is not so easy. Trading or trader, person who is trading, is an occupation like any other in the world, like doctor, lawyer, construction worker, etc. But what is different between these occupations and trading? That you are not able to go to university to get their bachelor or master degree and become a profitable trader. You have to find some quality information, to pass some program, get a coach, practice, self-adjustment, and through a long and painful road, you will succeed and become a trader. Nowadays, there are traders who works in hedge funds, banks, Wall Street, etc., so-called institutional traders. And there are retail traders, traders who is trading for a bedroom, so to speak, and do their own analysis. The one would you like to be, I think. In trading, you must accept the fact that you will not be right all the time, and you must accept losses. And for some people, it is the hardest thing to do, and breaks many, many people. You must accept losses, period. By the fact, if you will be right only the half of times, it means success rate of 50%, you will be successful in a short period of time. 40% of success rate to have is an optimal number, and not that bad. By the way, very profitable. The minimum success rate which you need is 25% to break even. Isn't that amazing? So what trading really is? In simple terms, trading is speculation between prices. When you buy something, you bet that prices goes up. And when you sell something, you bet that prices goes down. And of course, as you heard already, I think, trading is a high rewarding skill with huge potential. That is why so many people get into trading, but most of them failed miserably. So before start trading, you need to know what the hell you are doing. By saying you need to know what you are doing, I mean you need to know a lot. Right approach, good education, which is psychology, risk management, technical knowledge, fundamental knowledge, and many more. Then, you also need to have right mindset, experience for a demo account, and only then start your fighting journey. As I said, trading is complicated, but you can make it less complicated by knowing what the hell you are doing. It takes some time, I know, but it is the only way. You have to be able to understand trading so good, like ABC. In other words, you have to become a real professional. As we know already, trading is speculation between prices. Buying in trading is the act of purchasing an asset in the hope that its value will increase, thus potentially making the trader a profit. In trading, selling is the act of offloading an asset once it has returned the trader a sufficient profit, or if it has made a loss the trader is willing to take. Easiest way to explain trading is bazaar, where all kinds of people gather around to trade their products from money, so-called sellers, and buyers who wish to buy necessary products for money they have. So trading, which we are talking about, is similar. Just in this case, trading products is financial instruments, and this has greater liquidity. Buy or long position. The act of purchasing an asset in the hope that its value will increase. In the futures market, the buyer of a futures contract, on the other hand, is obligated to take the possession of the underlying commodity or the financial equivalent at the time of expiration and not any time before. Great example of buying would be with gold. I mean real gold. In matter of example, let's say we bought gold for a 10 grand we had and hold it for 5 years. Let's say gold prices increased during those for 40% and you sold it. Now you have 14 grand. And if gold prices decreased to 40%, so we have 6 grand, an accepted loss of 4 grand. It's just a simple example of buying and trading. Sell or short position. Selling is the act of offloading an asset. In the futures market, selling is an act of offloading an asset which you don't have the possibility to buy it back in the future when you close your contract. Sounds messy, but it is actually how it works. And actually, you don't need to know how exactly it's working. All you need to know that you can sell or buy. Many people think that you can make money only by buying, and later, when price increases, sell and get profit from differences. But actually, in trading, you can be very profitable only by shorting your positions. With the right approach and clear strategy, you will be able to do so. Again, a short position in trading is a strategy used to take advantage of markets that are falling in prices. When you make a short trade, you are selling borrowed assets in the hope that its value will go down and you can buy it back later for a profit. It is also known as a short, selling, shorting, or going short. Shorting is opposite of going long, where you will make profit if the prices goes up. For example, you are borrowing apples from a farmer and going to sell them somewhere for a current price, and later, let's say prices gets down in apple market due to increased supply, and you bought them back with the lower prices. After doing so, you return apples to the farmer and having some profits. Of course, silly example, but I hope you get the general idea. But what trading really is? In simple terms, market is the meeting of people, buyers and sellers, for purpose of trade, which actions appear on the chart. So our job will be reading psychology of a market, which is people, and define the direction and trade with the direction. How that happens and how these profits are coming so big. So trader borrowing money from broker, which is leverage. Leverage is an investment strategy of using borrowed money, specifically the use of various financial instruments or borrowed capital to increase the potential return of an investment. The future markets usually use high leverage. Leverage means that the trader does not need to put the 100% of the contract value amount when entering into the trade. Instead, the broker would require an initial margin amount, which consists of a fraction of the total contract value. As a result, margin investing can amplify gains, but it can also magnify losses. As we already know, you can buy, sell, or do nothing, and sometimes do nothing is the best that you can do. And there are days when market condition is bad, chart looks terrible, and the best choice is do nothing. Do not try to search for a trade when it is not there. If you can't see the right structure, details not saying much, in other words, there is no opportunity for right trade. So actions are clear. You do nothing. Of course, you have to trade when opportunity presents itself. Because with doing nothing all the time, you will have nothing. For now, you need to know that you can buy, sell, or do nothing, and we will leave it like this at the moment. Definitions that you need to know at the beginning. Bulls or bull market, climbing market. A bull market is an extended period of time when stock prices rise and investors are optimistic. Bull market can last for months or even years. When the economy is growing, unemployment is low, consumers are buying, and investors are optimistic. The stock market tends to see extended gains. This is the essence of a bull market. Continued broad gains in the stock that last for a long period of time. Technically speaking, a bull market is defined as a 20% gain or more in the stock market index or individual security as per Forbes. Bears or bear market, falling market. When the economy is on a back foot, investors tend to be pessimistic and stock prices decline. Economists define a bear market as a decline of a 20% or more of a major stock market index for a sustained period. On average, bear market occurs every 3.5 years, usually lasting for several months, as per Forbes. However, it doesn't mean that during bull market period, market is always climbing. Same with bear market period. Chart. A chart is a graph of data points where each point represents the security's price action for a specific period of time. A daily chart may focus on the price action of a security for a single day, or it can also comprehensively show the daily price movements of a security over a specific time frame. Time frame, TF. Time frame in trading defines lasting point at the chart. For example, daily chart, it means each candle or bar lasting for a day. Daily chart is too big for a day trading. However, it is very important and useful, and you're going to use it a lot. Indicator. Trading indicators are mathematical calculations, which are plotted on or below a price chart that can help traders identify certain signals and trends within the market. Tick. A tick is a minimum number in price a security can move on exchange. For example, stocks trading above $1 have minimum tick size of 1 cent. Point. A point represents the smallest possible price change on the left side of a decimal point, while a tick represents the smallest possible price change on the right side of a decimal point. For example, change from 16,000 to 16,001 in stock indices would be 1 point. So point is higher change of a security than tick. Leverage. As we spoke already, leverage is a debt, so to speak. So shortly, leverage refers of using debt, borrowed funds, to amplify returns from an investment or project. Companies can use leverage to invest in growth strategies. Some investors use leverage to multiply their buying power in the market. Stop loss, SL. A stop loss is designed to limit an investor's loss on a security position. For example, setting stop loss order for a 10% below the price at which you bought the stock will limit your loss to 10%. Take profit, TP. A take profit is an instruction to close a trade at a specific value to ensure your profit is realized and goes to your available balance. Liquidity. Liquidity refers to the ease with which an asset or a security can be converted into ready cash without affecting its market price. Cash is the most liquid of assets, while tangible items are less liquid. There are two types of liquidity: market liquidity and accounting liquidity. Do not worry if it sounds messy or you do not understand so clear. Supply. In economics, supply is the number of products that producer or seller is willing and capable to provide to buyers. In trading, supply refers to the amount of an asset that is available. As supply of an asset increases, its value declines. Conversely, as supply of an asset decreases, its value rises. Demand. In economics, demand refers to the consumer's desire to purchase goods or services and willingness to pay the specific price for them. In trading, demand is quantity of an asset that are people willing to buy. As demand of an asset increases, its value rises. Thanks so much for watching, and if you found this video helpful or interesting, please give it a thumbs up. It really helps the channel to grow. And if you'd like to see more content like this, make sure to subscribe and hit the notification bell so you don't miss any future videos. I would also love to hear your thoughts or questions in the comment below. Thanks again, and I'll see you in the next video.